And basically what the VCP is you've got that prior uptrend, then you see a base start to form, and then we see contraction in both price as well as volume will be doing kind of the same thing from left to right within the base. As those contractions tighten, the base is getting more and more primed and ready for a continuation up move that we can profit from as traders by jumping on at the proper low risk buy point. This is what we're trying to catch here. This is GEV. It broke out of a volatility contraction pattern back in late August. And this trend, this nice orderly trend, is what we're hoping to catch from these tight areas on the right-hand side of a properly formed VCP. So RMV compares the current volatility to the average over a look back period. A value of 100 in RMV, so like up here, means price is expanding to the upside. A value near zero or of zero identifies volatility contraction, and you can change the look back period. So this is really cool. And here we had the earnings gap, slight push up. Then we had the pullback into the 10 EMA on this time frame. The tight area formed, RMV went to zero, and then we get that U-turn I was talking about. Nice move up, and I think we're up 30% or so from this move higher. So let's go ahead and get started. Just a quick preface, this is my absolute favorite webinar to give, and there's kind of two main reasons for that. First, the VCP is, in my opinion, one of the best setups and edges that you can have in the market when used properly, and that's what we'll be discussing today. And that, there's a lot of caveats to that: a strong market, a strong stock, strong theme, all of that, and we'll cover that in today's session. And then two, RMV, Relative Measured Volatility, which helps you identify VCPs and other, strong entry points, I think can save a lot of traders a lot of time, a lot of frustration, help them analyze charts like a market wizard. And, even if they're starting out, it helps confirm what they're learning and seeing in the charts. So those are kind of the two main reasons that this is my favorite webinar to give, and I think you guys will really enjoy it. So thanks so much for joining today here live, and to everybody watching the recording, great to see you guys as well. This is going to be a great one. All right. Oh, actually, and before we get into it, just a few quick kind of housekeeping things. This is being recorded. So if you have to step away, feel free to do so. If you have any questions, please don't put them in the general chat. And if you see anybody drop a question in the general chat, please remind them of this. Please put it in the Q&A section. Otherwise, it's going to get lost in the shuffle. All of that. Please, I'm a one-man job, one man, I'm only one man here today. So please help me out. Put it in the Q&A. And that way I can answer as many questions as possible about trading VCPs, routines, process, system. That's what we're here about today. And I think this will be a great one. So welcome everybody again to finding and trading VCP setups with Deepvue and RMV. This is going to be a fantastic webinar. And to jump right into it, this is what we're here for. This is what we're trying to catch here. This is GEV, obviously a leader of this year and of the past few months here. It broke out of a volatility contraction pattern back in late August, and it's up about, it broke out 180s, and now it's trading, right around this area right here, 350 or so. A huge move, massive move, and this trend, this nice orderly trend, is what we're hoping to catch from these tight areas on the right-hand side of a properly formed VCP. And you can notice I highlighted a few tight areas here, which are potential entry points. VCP entry points and RMV, Relative Measured Volatility, help you identify them. And that's as well what we're talking about today. Another example, app. This is, of course, a huge winner over the past 2 years, both in 2023 and 2024. We'll take a look at this a few times in today's webinar, but another great example of a VCP breakout, classic technical textbook setup here, increase in volume on the breakout from the tight area right near the base pivot. And this is up, 200% plus in just a few months. If you can catch just one of these with a decent amount of size in your portfolio, it can absolutely make your year. And if you can catch it with some really good size, it can really push your performance in your portfolio. So that's what we're here today to try to identify a process, not just try to catch us one off, but identify a process to consistently identify this type of setup before it takes off, have a system to identify specific entry points to use to execute that setup. And then, the second half of the equation, which we'll be talking more about in future webinars, is managing a winner like this. So, stay tuned for that. But today we're really focused on identifying and finding VCP patterns and actually trading this breakout. And I'll be sharing some tips that, I've learned through trial and error, a lot of error, making a lot of mistakes that, allow you to catch this, but also if this breakout doesn't work, and this is important, if this breakout did not work and it failed, how do you protect your downside? Because honestly, this usually does not happen. Maybe you'll get a really nice move, and we'll go through a lot of examples, later on in this webinar, but often enough, this will fail. And, I think it's disingenuous when traders only show, hand-picked setups that worked, because most of the time, not everybody has a high win rate. And even in the best markets like we're currently in, you're maybe right, half the time on this type of setup. And you want to make sure that we're managing our risk, getting out with a small loss. So when it sets back up or you find another setup, then you have the confidence, you have the capital to execute to try to find a winner just like this. So really important today. We're not just going to show winners. We're also going to discuss, how to handle the downside and manage your risk. I think that's really, really important. All right. And again, we're not hindsight trading here. One thing I want to point out here with app, this has been a tremendous winner. And it's one that I highlighted in real time in the Trade Lab, my newsletter. So this is just to show that, if you develop this process, you can consistently find these ideas that can turn into these monster winners. The point of this webinar is not hindsight trading. It's how do we develop a repeatable system and process and routine to find these opportunities so that we can potentially execute and profit from them. And here are kind of my key goals of the webinar. If you can do just one of these, I think that's excellent. I think it's well worth your time. First, and let me move this Zoom bar here. First, read charts like a market wizard using RMV. Relative measured volatility, I think, especially when you are newer at this, really helps you identify those tight areas that the best traders pick up on. Oliver Kell, Leif Serede, Mark Minervini, they're all looking for that specific entry point from a tight area on the right-hand side of a mature setup or base. And, there's a lot of gold in that sentence. And RMV helps you identify that tight area and see it just like they would. And we'll go through many, many examples here. Second, know when a stock is ready to go. RMV and what we'll be discussing today really helps you know when a stock is actionable. There's setups, and then there's setups that are primed. And I'll kind of use that word a few times today, primed. And that means the next day they could potentially be breaking out. And that's when you really want to be focused on a stock, not when it's just forming any old base and still kind of sloppy on the right-hand side. We want to be focused on a name and have it on our radar when it's primed and ready to break out and, have an expansion period. Then our third goal is help you identify strong entry points from tight areas. This goes hand in hand with the first two. We want to help you develop a system, a process, so you can identify these strong entry points from these tight areas so you can profit from them. And then lastly, develop a repeatable process to find strong VCPs. We'll go through preset screens that you can use in Deepvue to do this. We'll go through kind of my process, which uses the Deepvue leaders screen and then uses RMV to sort your different stocks for looking at the tightest, first. But we'll cover a lot of techniques that can save you time during your screening process so you can find these, primed setups that much faster. So these are kind of the key goals of the webinar. And I really think by the end of today, you guys will have accomplished all of this and, improve your chart eye. This is what this is all about, improving your process. And I hope this is a resource that, helps you immensely. And, you don't feel like you just watch one time and forget it. I want this to be a resource that you come back to 3 months later, 6 months later, even years later. And I think we're going to achieve that with all the case studies that we'll go through today. And I think I've condensed a lot of really important knowledge that I've learned from these top traders into one presentation, and a lot of checklists, a lot of great slides that I think condense all of that into really manageable amounts. So hope you guys enjoy, and let's dive right in. So here's the agenda. First, what is a volatility contraction pattern to make sure we're on the same page? Then we'll discuss tight areas a little bit, visualizing tight areas with relative measured volatility. We'll dive into the indicator a little bit, explain how, how to use it, what it is, what it's good at, what it's not good at. Then we'll discuss screening for VCPs in Deepvue, trading tight areas, how to actually execute that. We'll go through the 4 ways to trade a tight area. Then we'll discuss, like I said, handling failed tight areas. That's really, really important that we cover this. We don't want to just cherry pick the winners. We want to discuss, how do we limit our downside if these tight areas don't resolve an expansion to the upside, or maybe they resolve into expansion to the upside, but then fail right away. So it's really important we discuss that. And then we'll go through a live demo in Deepvue. And like I said, we're going to be going through a ton of examples and case studies, examples from the past, 5 years ago plus. We'll go through many examples from this year, many examples just from this previous week that had really nice expansions from tight areas. So hopefully this will be really beneficial to you guys. And let me know in the chat right now if you guys are looking forward to this. And also let me know, what concepts you most want me to cover today and emphasize, because I definitely can tailor this presentation to what you guys most want to see. All right. First, actually, before we dive in, I do want to mention we're currently doing a Deepvue Black Friday sale, a special offer. This is our lowest ever price. If you've never used Deepvue before, check out deepvue.com. And you can sign up right there. If you're a current Deepvue user, whether you're a monthly or annual, go ahead and email hello@deepvue.com and mention Black Friday for details. Basically, you can extend your subscription by as many years as you want at our lowest ever price that we will never offer again. So this is our Deepvue Black Friday special offer. This is a fantastic platform that I'm part of the founding team. I've worked incredibly hard to bring features like RMV, customizable data panels, into the platform. And we've got so many amazing ideas that we'll execute on over the next year, 2 years, 5 years, 10 years. And I'm really excited about where Deepvue is going. And this is a fantastic value offer that I highly recommend you check out at deepvue.com. Or if you're an existing subscriber, go ahead and email hello@deepvue.com and mention Black Friday for details. All right. So what is a volatility contraction pattern? Well, it's basically a constructive base pattern within the context of a longer term uptrend. Now, this is a mistake that I see, I think a lot of newer traders, identify early on. They learn the VCP and they're excited about it, but they find these consolidation patterns, at like 52-week lows, or, within the context of a longer term downtrend. Those can work, and that can be a part of a bottoming process. But really, the VCP shines in the context of a longer term stage 2 from Stan Weinstein uptrend in a strong stock, in a strong theme, in a strong market. That's key. And basically what the VCP is you've got that prior uptrend, then you see a base start to form, and then we see contraction in both price as well as volume will be doing kind of the same thing from left to right within the base. And as those contractions tighten, the base is getting more and more primed and ready for a continuation up move that we can profit from as traders by jumping on at the proper low risk buy point. This base is basically caused because there have been some previous owners of the stock within this uptrend that have decided to sell their position. That introduces supply into the market, and that supply basically has to be absorbed as the stock kind of works through this price action. And it's being accumulated by longer term holders or new holders that still believe in the company. And when that base kind of works off all that additional supply that comes off, that's when it's ready to explode again. And that's what we're seeing visually through these contractions. And the volatility contraction pattern, of course, it was coined by Mark Minervini. His book is excellent. I highly recommend everybody check it out. I learned an immense amount from it. And this VCP is a great kind of framework that you can use to interpret price action and look for, primed entry points. But I do want to emphasize that Mark Minervini coined the term, but it's really a pattern and an element of market structure that almost every top trader has identified going back in history. Jesse Livermore looked for pivot points, Darvis boxes, William O'Neill cup and handle, Wyckoff springs, all of them almost looked for the same pattern because they noticed it appears so many times in the strongest stocks, and the most successful trades come from this type of volatility contraction pattern. So is VCP set up a cause or effect? Like I said, this is a function of supply and demand. Basing and contractions are caused by sellers getting absorbed by longer term holders or new holders, and buying pressure supports a stock on any of these pullbacks. And the reason that these get tighter and tighter is because the people who are accumulating, the largest funds that really drive major moves, aren't letting the stock come back any further. They want to increase their position size because they still believe in the company. Or just sellers are getting weaker. There's less supply coming to market. That's why these pullbacks get shallower. And, in reality, this is kind of the textbook look of a VCP. In reality, there could be tightening here, higher lows forming, and then a shakeout and quick recovery. That is still completely a valid VCP if we get a tight enough right-hand side. And you'll actually kind of see that in the recent examples with app, GEV, we kind of saw that. We saw a base forming, then a quick shakeout with the market as it pulled back in, and then it kind of reset, set up a tight area. So this picture, don't think that a proper VCP has to have perfect higher lows as it goes. There can be shakeouts, and those can still be very valid in the right stock, in the right theme, all of that. So as I said, selling pressure gets weaker throughout the base, and then it will set up a really nice tight area up the right-hand side of the base, and that's when we're looking to get into the stock as it breaks through a pivot point, offers a low-risk spot to jump on to the trend. And here's an example with William O'Neill. The cup and handle is basically an example subset of a volatility contraction pattern. William O'Neill looked for tight weekly closes, which is a key part of VCPs. He looked for volume dry up in the handle. That's an element of constructive volatility contraction patterns. He looked for larger volume up weeks, lower volume down weeks, a volume explosion on breakouts. If you see right here off the bottom of this base, you've got a VCP here, explosion up, it tightens up again. Both price and volume are contracting, and then look at the volume on the breakout. And this is an example from one of his model books that he created, and this led to an explosive move here and trend that we're trying to catch. And this is another kind of golden nugget that I want to mention here today. Recent IPOs, especially post lockup period, are a great kind of universe to fish in for setups in general, but volatility contraction patterns. GEV, a recent spinoff, stocks that are new to the market and aren't yet majorly owned by institutions. When something special happens, they start growing immensely. They're part of a winning theme like AI, semiconductors are right now, fintech. When recent IPOs are part of that and they're not widely owned by institutions and they start developing new products that are changing the game, institutions have to accumulate them and build their positions to get exposure. And that accumulation is what creates these type of chart patterns and the longer term trends that we want to be involved with when it comes to trading this setup and trading in general. We want to be involved in strong longer term moves. So just wanted to mention that. Also, as I mentioned here, you've almost got a VCP and then a mini VCP on the right hand side. So you've got patterns within patterns. And you'll kind of see that there's a fractal nature to this, and tight areas, within the chart suggest accumulation, and then that final tight area before the buy point, that's what we're looking for. But overall, you can see volatility contraction patterns within volatility contraction patterns. But keep it simple at the end of the day, especially if you're new to this. All right. Then, just as another example, this is the Stan Weinstein stage 2 breakout and continuation setup. And this probably looks familiar given what we just talked about right here. Look at that. He's looking for a volatility contraction pattern. And the buy point is after a tight area on the right hand side. He's got a downward trend line. Some people use a horizontal line. I prefer to use that, but it's all personal preference. But he's looking for basically a last tight contraction after a mature base is formed within the context of a longer term uptrend. Look at the volume in this diagram. It increases a little bit on the moves up, declines during the moves down, and then contracts from left to right within the base, and then explodes up at the proper buy point, and then the stock is off to the races and within the context of a longer term uptrend. Especially if you're new to trading VCPs, focusing on stocks in stage 2 is incredibly important because it increases your odds that institutions are behind you because they're driving this longer term move. So that's another example from Stan Weinstein. Let me get a quick sip of water here. All right. So tight areas, why are they important? And here we're looking for tight ranges, tight closes, low volume. Number one, it indicates a lack of sellers, a lack of selling pressure. The stock is being pinned at that level, and any supply that's coming to market is being absorbed by those institutions or longer term holders or just people who want more stock. And it's a key sign of accumulation as buying pressure pins the stock to a level, as I just said. And the key thing is, a tight area over here on the left-hand side of the base might just be, a characteristic that you look for that says, all right, the base is under accumulation. That's good. I'll kind of add to my watch list and revisit it as the base matures. A tight area over here, if you notice that again, all right, the base is getting a little bit more mature. There's another tight area that formed right here. The stock is starting to push off the lows. I'll move this up to more in my focus list. I'm waiting for that final tight area. It's not quite ready yet, but those tight areas are evidence that the base is under accumulation, and then I should be paying attention to the stock, especially if this powerful move was very powerful. And of course, the stock is in a very strong theme, industry group, and has explosive, characteristics like the end and can slim, earnings growth, sales growth, all that. That's when you really want to be focused on the base and get on it early and start to notice the signs early that the stock is under accumulation within that base. Then finally, when this final tight area forms here and the base is finally mature, maybe this is 4 weeks long, 3 weeks long if this was really powerful, that's when you really want to be focused on it, because the tight area can be used as an entry tactic / setup. And the reason that it's really good at that is because, one, it forms a clear pivot point, the high of that last contraction, that range. And we'll go through a lot of real examples as well, not just diagrams. It forms a clear buy point. So if it breaks through that, you buy. If it breaks back below that, you were wrong, you get out with a small loss. And that's really key. And also, this last contraction, because if it's tight, within 3-5%, you can easily place a stop loss at the low of that last contraction and manage risk really tightly. I personally, when I trade a tight range, and we'll talk about this later, on that breakout day, I usually like to place my stop at the low of that breakout day or the low of the day before to keep my risk even that much tighter. Within about 3% is usually my goal. But this last contraction allows you to keep that risk in check and really, really tight, which helps you, overall with the math behind your trading. Then also, as I mentioned, because it has such a clear buy point and you've got this, tight contraction, very quickly if the trade's not going to work out. If it reverses back down, you were wrong. You have to accept that and take your small loss. Maybe the stock wasn't, quite right yet. Maybe it needed one more contraction or maybe a shakeout and then formed up another tight area. Whatever the case may be, in that moment, you were wrong, and it's better to kind of exit the stock, revisit it when it sets up again, if it does. And this can save you a lot of frustration, a lot of big losses if you get out quickly and have an entry tactic like the tight area, execution that allows you, quickly if you're right or wrong, and keep your risk very, very tight. That can save you so much over the course of your trading career. And in addition, because you can manage risk really tighter, this is just an aside, when you're more experienced, because you can manage risk tightly, you can size up a little bit bigger, especially on the most prime setup like an app. And then when you get that expansion and you're right, you can quickly move your account higher. So that's the benefit, especially for more advanced traders, is when you've got this entry tactic that allows you to manage risk very tightly, you can size a little bit bigger in the best environments, the best, market setups as well, and really have a fantastic year and really make the most of a trade like an app. All right. So what makes an actual tight area? Here's a good checklist for you guys to remember. So pay attention here. This is an important slide. These are all important, but this is more important. One, we want the stock to be a very strong stock showing relative strength, gap ups, strong prior moves, a new stock, have that N factor. We want to be backed by a prevailing story, theme, or edge in the market. This could be a theme like fintech, which we've seen recently. It could be AI, semis, whatever's in vogue in the moment, and you're seeing other stocks do well. If another stock that's setting up a setup is in that same theme, that adds to that quality of that setup. Then we're also looking not just at the tight area, but the overall context of the chart and the stock. It's always best when this tight area and base occurs as a part of a larger weekly setup, a big base. Maybe this base is set up near previous all-time highs. That would kind of fulfill this criteria. But this tight area should always be taken in context of the base it's in, or if it's right over the base, how strong was this base, how long was this base, and then ideally it's near a longer term setup that's also strong and powerful and primed for higher prices. And we want this tight area to occur near a key level. That could be the top of the base. That could be near a key moving average like the 21 EMA or 50 SMA. It could be the anchor VWAP from lows or a recent earnings gap, or it could just be just over or just under a base pivot as we have in this example. And we want to make sure that it's not just any old tight area. It's tight enough to manage risk against the range lows, low of the day, as I mentioned. And the best tight areas, when they're especially primed and ready to go the next day, and this is what I'm looking for every day as I'm building my focus list, I'm ideally looking for an inside day or an upside reversal on the right-hand side of that tight area within the context of a larger term setup, as I mentioned. And that's because that tight area, that tight inside day or upside reversal, creates the expectation of expansion the next day. For the upside reversal, we're looking for follow through up. It had some momentum as it moved off the lows the prior day, and we're looking for follow through to the upside. From that inside day, what it suggests is even more contraction on an intraday basis. And often you get tight inside days on very low volume right before explosive moves up. And we'll go through some examples in real charts later on showing that. And then as I mentioned right here, we want the stock to be part of a group move ideally and be moving with power and volume. That's key. And here's some more kind of detail here. The best tight areas occur near the top half to just over a big base breakout, or it could be at the first 21 EMA pullback after the base breakout. We want to be focused on high momentum names first pullback to the 10 EMA. Maybe you had a gap out of the base and it's so powerful it's not even going to pull back to the 21 EMA until it's up 50%. That first pullback to the 10 EMA, especially after an earnings gap, and if it sets up a tight area right there, can be very, very actionable. Then on any pullback here, we're looking for lower volume compared to the move higher. And ideally, as I mentioned, you get some type of shakeout, upside reversal, or inside day to really prime that tight area and get it ready for an explosive move. And this is kind of a concept that I really want you guys to focus on today. One of our big goals is to help you guys understand when a setup is primed for a big move. And this inside day / upside reversal in a tight area, in a strong chart pattern, it's a key thing to look out for. And here's another thing I want to mention. The classic volatility contraction pattern is a base that contracts from left to right. But a newer element of market structure is these earnings gaps. And this past market cycle, there were so many examples, and there still are so many examples. And you can use the volatility contraction pattern characteristic in these type of setups as well. Basically, what you're looking for after the big move up on the earnings gap is a tight area or slight pullback to form, and then you're looking for a breakout from that as it tries to kind of U-turn back higher and start a trend. So that's exactly what I say here. After a strong gap from a catalyst, stocks will often tighten or form a U-turn. Tight areas can help you position with size. That's a quick typo. After a stock has already shown its special. So this is key, especially for traders. I know many of you out there probably do this more part-time, that you work full-time, and you might not be able to catch an earnings gapper on the first day. This can be an entry tactic that you can use. So when it's already on your radar, maybe you notice snowflake gapping up big, you can wait for the tight area to form, the U-turn to form, the pullback to the 10 EMA, and then you can execute with the confidence that the stock has kind of already shown its hand and shown its power. And if that earnings gap is strong enough, that's a stock to be focused on to see if it will work. Of course, you always want to manage risk, but earnings gappers are a tremendous setup within the context, again, of a strong overall stock, theme, and chart pattern. And when gaps are in vogue, this is an excellent entry technique, as we've seen, with many examples over the past few weeks or so. Here's an example with Reddit. This is a 195-minute chart. Sometimes for these recent earnings gappers, I like to go to a 195-minute or a 65-minute. That just kind of splits the day's action a little bit into either 2 or 6 respectively, and shows you a little bit more of the detail behind it. And we had the earnings gap, slight push up. Then we had the pullback into the 10 EMA on this time frame. The tight area formed, RMV went to 0, and then we get that U-turn I was talking about. Nice move up, And I think we're up 30% or so from this move higher. And I added to my position on this day right here in the morning as it pushed through this pivot. I had an existing position from lower within the base, but this was a constructive add. It's shown its power on this earnings gap. I think it was about 40-50%. It already had shown itself, and this was right near all-time highs. So again, that larger pattern was very constructive. And then you can do an add or start an initial position, using this type of U-turn type setup. So just want to, add a bonus to this presentation with the post-gap volatility contraction characteristic. All right, so we've talked about what it is. Let's go ahead and actually help train our eyes here. So train your eyes, look for tight areas of VCP action, look for tight ranges, tight closes, low volume up the right-hand side of a base. Tightness can be even 2 to 3 days. And that's what RMV really helps for, is it can really help identify those subtle tight areas that the market wizards who are very practiced, they've looked at thousands, if not millions of charts, and they know the subtle nuances they're looking for, those tight inside days after a move up, those subtle tight areas. RMV can help you spot that as more of an amateur, intermediate, whatever your level is. It can help, spot that for you, or just kind of confirm what you're already seeing with your chart eye. And what I look for is tight RMV, less than 12, less than 5 is best, 0 is even better. And often RMV will go to 0 right before a stock breaks out from a base, as we'll see in many different examples that I share today. So here's the first exercise for you guys. So wake up. It's time to do a little bit of work here. We want to make sure that you're applying this material and not just sitting here passively. So train your eyes, look for tight areas in VCP action. On this chart of PLTR, which again was a recent IPO, that's another thing to focus on recent IPOs. Where are the tight areas on the chart here? Kind of think for yourself, go from left to right on the chart and identify all the different tight areas visually for you. And you can use RMV a little bit when it goes to 0. That's kind of a clue that a tight area might be forming. But try to think for yourself first and identify these tight areas. And I'll take a sip of water and give you guys a little bit of time here to do this. Let's see here. And how's everybody doing? Enjoying the presentation so far? Let me know. And for the most part, these are daily charts. I will point out some weekly charts, monthly charts, because you can use the RMV concept. It's fractal, like I mentioned. But for the most part, these will be daily charts. Okay, awesome. Getting a lot of good feedback. So very nice. Okay. So think, look at this chart, identify the tight areas, and I'll show the example in just a second here. All right. So this is kind of the tight areas that I've highlighted, and there's some more. There's one back here. These pullbacks are very tight, but these are kind of the tight areas that PLTR shows here. And there's a nice expansion move here that you could catch, a nice quick expansion move. This is like a 50% move in 3 days. That's the type of power that you can have in the best RMV and VCP setups. But the key thing I want to point out is you have this base, you have the tight contraction, expansion, and the strongest stocks will continuously kind of rotate between expansion, contraction, expansion, contraction, expansion, pullback, needs to form a new base, very sharp pullback, tight areas within the base suggesting, again, stocks being accumulated, there might be another move coming. Tight area at the low of the base, moves up, goes tight again, moves up again, goes tight again for a few days, expansion up, volume comes in, and you get this 50% move. So really what you want to do is be able to train your eyes to look for that expansion, then contraction, expansion, contraction. Look for power, another base to form, more tight areas suggesting accumulation. Those can be entry points if you want, but the best entry points are really as the stock matures here, and then look for that expansion from that contraction. You'll probably hear me say contraction so many times this webinar. Apologies for that, but that's the concept that we're teaching here today. So let's train our eyes even further. Let's discuss some historical VCP and tight area examples. Here is Shopify back in 2016. Again, if you go back in history and study the biggest winners and look at their bases, there's going to be a lot of examples of this, of both tight areas that form at the belows of bases, suggesting accumulation here. You can see this basically goes nowhere for 2 weeks here. There's this big upside reversal, but where's that close? Right in this tight range here. That's a sign of support right here. This isn't a negative bar. This is a positive bar, suggesting that this is being worked off and the stock is being supported at that level. Where does it retest again? This same level here. It's being supported, moves back up, tightens. So again, tightening from left to right. You get a shakeout. Again, this isn't the classic textbook VCP because you do get a lower low compared to this low, but generally from left to right, we're seeing that volatility contraction. And look how tight this is compared to this action. It goes a little bit sloppy, higher volume to volume kind of declining overall. Look how low compared this is compared to average. And then this really tight area, RMV going below, going very, very low here. And then we get the expansion up, contraction, expansion up, contraction, expansion up. Volume really comes in. The average volume increases after the breakout. That's another clue to look for. And this is just a great example from Shop. And this was a recent IPO at the time. Again, that's something I want to highlight is many recent IPOs are kind of the best setups, especially when they're in a new industry that's taking off. E-commerce was a theme here. Of course, Amazon was the leader, but this was kind of the new kind of upstart when it came out. And this is split adjusted, so don't think it was such low price back then. Here's Shop, a little bit later. It had a nice expansion move higher, and then it was time to form another base. We had enough, trend, and it got a little bit sloppier here, and we start to form a consolidation. You can see a resistance line that happens a few times here. Again, we're starting to form a base. We're pulling back. It's a little bit sloppier, but then we start forming these higher lows, contractions. Again, moves up on higher volume, pull back on lower volume, and we get tighter and tighter. And again, we form a really nice tight area right near this overall significant level. That's key. Again, the tight areas should always be taken in context, and the best ones occur near a higher time frame or more significant level, like a base high, a prior all-time high. Those key levels, a Livermore levels of 100. The best tight areas occur right near a significant resistance or support level. And we get a tight area, expansion up, look at the volume come in, and then we just restarted another trend. And Shop, of course, has been a tremendous winner. And this is how you could have traded it from this tight area. These highs would have been a nice shorter term entry. This bar would have been the one you want to execute on. But even the next bar using this level, you could have entered right near the open, set your stop below the day, and you were never tested. And it broke out of the base. All the time frames were aligning. This pivot lined up with this pivot. We broke through all of that in one day. And it gave you no stress, and the best breakouts do that. So that's what we're looking for. Some water here. Here's the Google IPO base in 2004. We're going back 20 years here, and this is still the case. And this was a 100% move in 40 days from the lows of the IPO base. It IPO'd, pulled back, formed the base, as many of them do. RMV went to zero here, got very, very tight. RMV's pointing that out for you. Then this is the day you want to execute. Pick up in volume compared to recent days, expansion higher, and the benefit of trading these tight areas, and this is one of the key things I also want to emphasize today, is trading these tight areas up the right-hand side of the base often gives you the luxury of handling the volatility that often happens near the high of a base. These base breakouts, they work in the best markets, but they're a little bit more of a known setup when it comes to everybody in the market right now. And often near these base pivots, swing traders are taking profits. There's people who are looking to short at this area to play the reversal down. And there's often a lot of volatility near these base pivots. We saw it in Shop. When it gets to this level, we reverse down, reverse down. So if you're waiting until this level to buy, to try to play a trend, one, you're entering a spot where you can't manage risk, because if you use a 5% stop loss here, there's no technical reason to use a 5% stop loss here. But if you're over here on the right-hand side, you've got a higher low to play against. The stock has proved itself more to you. And if you buy from this tight area, whether you're buying through these highs right here and it pushes higher, or the next day as it pushes through this level, you have a profit cushion before we test this key base pivot that's more in the eyes of the market and where volatility can appear. So if you have a profit already, you have a profit cushion from entering a little bit lower at an early entry point, you have the luxury of sitting through that volatility with a nice profit. You're never tested, and then you can profit from that trend. If you wait to buy at the base pivot, if there's a lot of volatility and shakeout, it might ultimately work, but you might be stopped out if you're using a tight stop. So again, that's another key benefit of trading these tight areas is you get an earlier price and you have a cushion going into that base pivot. That's a key thing that I want to mention here. And from this tight area, suggesting accumulation, nice expansion move higher. And of course, Google has been one of the greatest stocks of all time. Here's another example, FSLR 2007. Obviously, probably many of you know FSLR from recent days, but it was another recent IPO that had tremendous power. It already had a really nice move before this, and then we pulled back, formed a base. This level became significant. You can see it was rejected down from it here. And then, it moves down. This is a classic base. We move lower, then we rally back up into the moving averages, tighten up, pull back here. This is a tight area suggesting accumulation. RMV going to zero right here. We move a little bit higher, pull back again, move higher, pull back, starts respecting the moving averages, move up higher. And this is what we're looking for. The tight area right below the significant level. And then we get the breakout, a pickup in volume here, and then the trend that we can profit from. And I think this moved 80, 90, or actually I say here 100% in 70 days. So if you can catch one of these in a year, a handful of them, you can have a tremendous year if you get 10, 15, 25% size, which you can because you can manage risk so tightly using these tight areas. And then after the breakout, it respected the moving averages. And then this is where we get a break of the trend, breaks this downward trend line or upward trend line, as well as the 21 EMA, and changes character and just needs another base to work things off. But again, we see the accumulation within the base by identifying the tight area. We form higher lows. We form one last tight area right below the significant key level. This is the one we want to execute from. You get the upside reversal, and it's off to the races from there. PANW, this is another recent IPO. This was within its institutional due diligence phase. So it had IPO'd and then started its base, and then it formed the setup on the right-hand side. We have a recent gap, and then look how tight it gets after this gap. Nobody wants, even though it gapped up, nobody wants to sell and not nearly enough to pull it back. It respects the moving average. It goes tight, and then we get the breakout right here. And then from this point on, I think it was a 60% move in 70 days. And this started the longer term trend that position traders and active investors can ride 300% in 400 days. So this entry is good for swing traders to get an immediate profit, and it's good for position traders to get on a strong, fundamentally sound stock for a longer term move like we had with PANW. And I definitely advise to not just look at these charts, but go back and look and study these stocks for yourself. Study the tight areas that form after the earnings gaps up the right-hand side of bases near the significant key level. And you can see there's a tight area before it broke out, and then it goes tight again. So it gives you the opportunity to even add, or if you miss this initial breakout, you can add through these highs of this tight area. So this is a great example. And let me actually see if I can zoom in here. There we go. So look, we have a gap up, and then we form tight. We do a little bit of shake, but overall this is very, very tight. And then we get this nice push higher through the base. That's what we want to execute on. You can even execute off the moving average outside day right here. And then we go tight again, form a nice tight spot right above the base pivot. And then we get that breakout, and it's off to the races again, respecting the moving averages. And that's, a great example, PANW, and a great stock to study overall from this earnings gap and tight area right near this key level here. And let me see if there's any key questions here. All right. All right. And my apologies if I can't get to every question, because there's a lot to cover today. And I think I'll cover pretty much all the common questions that are asked throughout this entire presentation. Here's Tesla back in 2019. Again, this was a gap up from an overall big base, and we had a strong gap up, huge volume coming in. This is when they first turned a profit. It was a prize profit. And then what do we form after the gap up? We get a tight area that forms, suggesting accumulation. We move higher. Swing traders can sell to strength. We pull back some. We form another tight area, and then we do 190% in 70 days from the spot. And where does it pull back to? It pulls back to the high of this prior tight area. This is a key nuance that I've started to pick up here since I've been really looking at these tight areas, is pullbacks often respect the highs of the prior range. It basically becomes an area of potential support. And often if you get a tight area forming on top of another tight area, that's when we really start to have an explosive move higher, as we did with Tesla back in 2019. TTD back in 2020, we have the base form, volatility contraction pattern. We have the handle form. We get a nice shakeout within here. And then we get the breakout from this area on pickup in volume and a really nice trend, 200% move from this area. This is when I traded as well, back during this time. Great example. You had a subtle tight area here, positive expectation breaker on this day. You can see we moved down, and the next day, what do we do? Or actually, let me break it down. The positive expectation breaker happens because we have this tight area that forms. We break below the lows of that tight area, and then we get a positive expectation breaker. Because what's your expectation after a bar like this, where we have a tight area and we break below that? And ignore the right-hand side of the chart. Think in the moment. If you have a stock that breaks below a tight area like this, and keep in mind this is early on in an uptrend, so there's a lot of doubt, a lot of fear going on. Your expectation after a bar like this is probably it's going to fall apart, revisit these lows, and there's a lot of negativity there. Instead, what does the stock do? It gaps up the next day and pushes higher and breaks through the highs of this tight range. And your pivot point to buy on that setup could be the high of the downside reversal day, or simply the high of the tight area. And it just so happens that those line up to be pretty much the same level. And that makes the entry tactic that much more successful. And you have a push up, and then it forms another handle near that high of the base pivot, and then goes from there and breaks out again. But what I wanted to show here is people are going to ask, can they use this on weekly charts, monthly charts? This is the same chart and time frame and stock as the previous one, but this is a weekly chart. And what do we get here? We get as right here, you can see this is the daily chart. We form this handle. On the weekly chart, we're forming an RMV tight area, nice upside reversal as well, breakout, and then 200% move. So you can absolutely use RMV on a weekly chart to find those handles, find bases. On a monthly chart, it's great at finding bases. I'll show an example with app later on, but this is a great example of a nice base, handle, and RMV going to zero right before the explosive move upward. And you might notice these dots here. We have a technical patterns Deepvue indicator, which allows you to plot on the chart a dot anytime RMV goes below a certain value that you set. So if you want to highlight whenever RMV goes below 5 or below 2, you can have a dot plotted on your charts in Deepvue that identifies that part. So it can help with your execution and identify those tight areas in addition to using the standard indicator. All right, let me get a quick sip of water here. All right. Characteristics of the best tight areas. So just revisiting this because I think it's so important, and this can help your trading overall, not just trading tight areas, but focus on setups and tight areas in the top half of the base, or just over that base breakout. So kind of minus 10% from the base pivot to plus 10% above the base pivot. Also focus on the 21 EMA pullback after the base breakout, especially if that breakout was extremely powerful. And I say 21 EMA because you want the stock to pull back pretty significantly to set up a good risk reward spot, to have another, enough juice to go on a nice uptrend for you. So a 21 EMA pullback, the first one, usually is a pretty good opportunity. And if it's a high momentum move, or like an earnings gap from a base, you might want to use the 10 EMA instead of that 21 EMA. Also during the pullback, you want to see low volume. And like I said, shakeout, upside reversal, or inside day really primes that setup to really be explosive for you. All right, so let's get into some 2024 VCP and tight area examples to keep training your eye here. This is app again, 65% move in 30 days. RMV went to zero the day before this breakout. That's why it showed up on my screens. That's why I was focused on it. And this RMV can save you so much time. You can screen buy it in Deepvue. You could say, hey, give me all stocks RMV less than 5. And then you can just go through those stocks and say, is it in a good overall setup, group, all of that. But being able to screen by RMV and also sort your screens by RMV allows you to focus on the stocks that are the tightest in the moment and most ready for the next day. And this was a great example, great breakout, nice volume, textbook, exactly what we want to see. And where does this tight area occur? It occurs after a powerful move off the lows. And this orange line is the base high here. And that base high lines up with the 21 EMA. So why was this move so explosive? Because it had many different things going for it. We had a powerful move off the lows. It was showing accumulation because it respected the 200-day moving average, and it pulled back to the base pivot as well as the 21 EMA, got very, very tight, volume declined, and then many participants were looking and accumulating shares, and that's why this breakout was so powerful, because you have the confluence of multiple key technical areas lining up together. That's what we're looking for. And imagine kind of trading this versus trying to trade the breakout here. You're kind of chopped around here. You might lose faith. You might be stopped out or just be really discouraged and sell your position. But instead, if you wait until the tight area and you know that when RMV goes to zero, a stock is primed, then you're ready both mentally and financially to execute on the opportunity. And one more thing I want to show here that's really cool is this is RMV on a monthly chart. So there's a monthly chart of app showing its entire move. And let me move the zoom thing here. And basically on a monthly chart, what a low RMV and a RMV to zero shows is a base, and when a stock is primed for a bigger move. So you have this decline here. You actually have a tight area that forms, tight closes here, RMV goes to zero, and we get expansion down from that contraction. Because one thing I do want to stress here today is this is in the context of a downtrend, and a tight area within a downtrend is typically going to resolve to the downside and lead to an expansion to the downside. Then we start to pivot. RMV goes to zero right here. This is our first actionable base. We get a breakout move from that. It moves higher. We start to form a base. RMV goes to zero again. We have a breakout from that. And then we have an expansion higher. RMV goes to zero again. And then we have the recent expansion higher. So RMV on a monthly chart can help you spot those bases and basically stocks with even bigger potential because higher time frame setups, especially when they align with daily and weekly setups, are the best potential for a longer term move and a really explosive move as well. Here's another example, QFIN, another 21 EMA after the base breakout. Great example, very nice tight area. RMV went to zero, expansion up, 30% move in 11 days. This was very nice. Duolingo, we had one back in here at the top of, so this orange line, this is a key level because it's the high that was set in the IPO move. So if you look at the chart, and maybe we can look at it in just a minute in Deepvue Live, but if you look at the chart, this orange line is the level that was set where the stock moved up higher to the IPO, and then it formed that longer base that's just now moving up higher from. So this formed a tight area right against that key level. We get the breakout, 35% move in 12 days. We go tight again. I tried it in here. It failed, but again, I was able to manage my risk really tightly because as soon as it failed, I cut my loss. And then we have a reset tight area against the 21 EMA. That one, there was no heat on it. And this has led you to have a really nice move recently as it continues to respect that 21 EMA. So if there's a tight area that forms and it doesn't work, don't take the stock off your watch list. Keep it focused. So if it resets and forms another tight area, it can be actionable and one that you focus on again if the story is still good, if the overall context is still valid, of course. SE again, pull back to 21 EMA as well as a confluence of the prior base. This was just an excellent example and really nice expansion move, 20% in 10 days. And then we reset again, and I think, it moved higher again. So a really good example of a pullback to 21 EMA lining up with a base pivot. UPST within this base, it had really nice subtle tight areas that really, if you're not a market wizard or you're not using RMV to point out when RMV goes to zero, you're not seeing these, and you're waiting until this base breakout, which worked in this case, but often, like I said, there could be easily a failed breakout, a reset, and then it works. So if you're in from lower buy points, you've got a better cost, you can manage risk tighter, and you've got a profit going into that base breakout attempt. ASTS, this of course was one of the monster winners from this year. Huge catalyst base gap. Then what does it do? It sets up that post gap U-turn we talked about. Tight area, you can see RMV going to zero right before it breaks out. And then this set up multiple high tight flags where each of those were identified the buy points by RMV as well. And this moved 150% in 14 days and then 1,000% over the course of the next few months there. RBRK, this is another recent example from this past week, but it set up a subtle tight area here within the IPO base. This was a recent IPO. Right here, the tight inside day, RMV going near zero, breakout, this gives you the benefit of sitting through this volatility that occurs near the high of the IPO base. And another reason why this is better is because we are so short-term extended going into this base pivot that even though we go tight, you want to be waiting for a better entry. And it ultimately works, but there's a lot of volatility near this base high. And then as the best stocks do, it expands up, goes tight, expands up, goes tight. And then we recently had a 15% move in 3 days off the 21 EMA and tight area confluence right here. The tight area starts to form here. This is your pivot. Then you can act on the upside reversal, follow through, and really nice move in just a matter of a few days. Great for swing traders, especially the recent IPOs. Oklo, another good example of RMV identifying the subtle tight areas, as well as the recent move. You got a tight area here, RMV going to 0, and then we get a 20% move in 1 day, and now we're going tight again. So we'll see if we expand again. If this flags down, RMV will come down, identify the tightness, and then you're looking for the expansion move up. But a powerful move like this, especially near the base highs, could just expand through. But this is the proper buy point. Again, it gives you a nice profit cushion. And in a really volatile name like this, if you can find a tight area like that, that gives you enough risk management that you can size this a little bit bigger to take advantage of a move like this, because this is a fast mover. If you can only get 5% of your account in this, it's not going to move the needle much, but you want to protect your downside, and that's where the tight areas can benefit you. Another example, Lunar, another really fast mover. Within this base, look at what happens right before it takes off. We get a RMV tight signal, just like that. Tight area forms right near the 21 EMA. We get expansion up, volume starts to come in, and then it gets extremely volatile up here. But the benefit of getting in at the tight area is the expansion gives you profit cushion, so you can then deal with this volatility, or you're looking to sell into strength, especially in a name that moves 70% in 5 days. And by the way, RMV doesn't just work in these fast movers. It works in Nvidia. It works in the slower names as well. So whatever suits your style, RMV can help you spot the proper buy points. And the tight area concept applies to any stock because it's an element of market structure. MSTR, multiple tight areas here near the base pivot before it went on this explosive move. And then recently, I pointed this out in the report. So again, not hindsight, tight days, RMV went to 0. And then we had a 50% move in 3 days. And again, you're a swing trader looking to sell into strength here. Maybe you sell on this day and get a 20% move. That's still fantastic from a risk reward perspective. Or if you're waiting until here and selling as it reverses down, that's still a stellar trade. But the entry point from the tight area puts you into a winning mindset and position because you have that profit cushion. You're not trying to buy up here through this high and you have nowhere to manage risk. You already have a cushion going into that, and you're playing the expansion from the contraction. Here's Nvidia. Like I said, position traders can use it as well, and I traded this. You've got the base, you've got the tight area that forms, RMV goes to 0 here as well as here. Then we get the gap up and strong move higher. So you could have entered from this range here and played the earnings gap. You have enough cushion to hold through, and then the resulting trend from that. So this works in all type of stocks. All right, Affirm recently, and again, we had a tight area that formed in the confluence of a key level within the base here. So we tried to push higher, we pull down, tight area forms, RMV goes to 0, and then we get expansion move up, pull back again, expansion move up, and then again at the top of the base, so this was at all-time highs or 52-week highs, we have a pullback after the expansion up, RMV goes very, very low, you've got that confluence of that prior base high, and then we get a really nice move in just a matter of a short amount of time. I think there's 20-25% move, but the tight areas again help you find the ideal entry point. All right, so just to sum it up again, let me get a drink of water here. Revisiting the characteristics of the best tight areas. The best ones occur near the top half to just over the base breakout. Often the first pullback to 21 EMA is really good, or with a high momentum name or a recent earnings gap, the 10 EMA. Low volume on the pullback is what we're looking for. Ideally, we get a shakeout or upside reversal or inside day to really prime the setup. And then we want this to be part of a larger theme and catalyst. Recently, it's been AI, it's been fintech, it's been crypto. Those are the themes that are working, and those are the stocks that we're looking to find swing trade or position trade setups with tight areas in. Then ideally are also looking for a fast mover, recent IPO. That's what works best for swing trading. If you're more of a position trader, this isn't really a requirement. Recent IPOs are still a great universe to fish in, but this is more for the swing traders here. All right, so we've talked about what they are. We've trained our eyes quite a bit. How do we find them and set up a system to do that so we can make it repeatable? So how to find VCPs in tight areas easily. Let me get a drink of water here. All right. Here we go. So how do we find them easily? Well, you can use relative measured volatility. I saw a question, can you only trade VCPs using Deepvue? And the answer is no. But we've developed features and we have the proprietary RMV indicator only found in Deepvue that helps you trade them and find them easier. You can screen by it. You can sort your screens by it. So it just saves you time and helps you trade and find them easier. So you can trade this whatever software you're using, but RMV, we specifically designed key features to help you do that. So let's discuss RMV and what this actually is. So RMV compares the current volatility to the average over a look back period. A value of 100 in RMV, so like up here, means price is expanding to the upside. A value near zero or of zero identifies volatility contraction. And you can change the look back period. So this is really cool. The default is 15 days. I think that kind of works best. And if you are somebody who just likes plug and play, use 15. But you can adapt that to suit your needs. If you're more of a swing trader, you might use an RMV of 5 or 10 to be a little bit more sensitive to finding newer tight areas. But 15 works for most people most of the time. And I'll talk about when I personally change this default. So why use RMV? Well, it's an objective measure of contraction on a relative basis. It is based on math. It's not based on my personal view of how I look at a chart, which may be different than how you look at a chart. It's based on math, and it basically measures the volatility of the current period versus the average and identifies, is that very low or very high based on that average. So it's an objective measure. It saves time during screening and sorting, as we'll get through and show examples, and it helps draw your eye to key price action. So if you're more of an experienced trader, you can probably spot these tight areas, but it can be a confirmation of that. Again, it can save you time during screening. It just helps you overall if you do trade that style already. And lastly, as we kind of talk through, it helps identify when stocks are ready to go, when they're primed. RMV of 0 really means that there's expansion coming probably the next day or in the next few days. So that's when you can be ready to act and potentially profit from that expansion as a trader. So interpreting RMV, here's a Nvidia example, and this actually, so I made this slide when the Nvidia example that I used prior, was setting up. So this is in real time almost. When we're very low here, so this is below 5, pretty much near 0, we're getting price contraction. So here on the right hand side, price contraction, RMV 0. In this area, you might be like, hey, price doesn't look too tight, but look at this 3-day range. All the closes are close together, and that's what we're identifying with RMV. Here again, all the closes are close together. RMV goes to 0. Here again, goes tight here. RMV goes close to 0. So it's identifying that subtle contraction that most people do not see or can't see that easily unless they really train their eyes over many, many years. Here's a great example with DocuSign. You can see how we expand up, contract, and RMV shows the tight areas every time. Right here, tight area, move higher, tight area again, move higher, expansion up, tight area, gets very, very tight for many, many days right here. We expand down. Again, we can expand down from a contraction. We go sideways again, get very, very tight. RMV goes to 0 right before this expansion higher. Go tight, RMV goes to 0. So you can kind of follow along with RMV and the chart and kind of see exactly what it's looking for and trying to identify in the chart. So do I always use a 15-day look back period? I know this is a question that many of you guys have probably asked in the Q&A or in the chat right now. No, the answer is no. I use RMV 5 as well for IPO bases, recent gaps, and very high momentum movers, high ADR percent names, usually over 4%. And if I just kind of want a quicker signal that highlights more subtle or more sensitive tight areas. So if you want to highlight, inside days in just a little bit of tightness, RMV 5 is probably for you. If you really want to focus on more significant if you're more of a position trader, more significant tight areas, you probably want to use a RMV 15, just the default. But you can tweak that and look at a bunch of charts and see kind of what suits your style. This is RKLB. This would be a name that's a very fast mover. Here you want to use an RMV5, which you can see is more sensitive to expansions and contractions, but still identifying the same tight areas and being even more precise. You can see this very tight area right before it broke out here. RMV5 went to 0. And I think RMV15 did as well, but there will be some circumstances where RMV5 points out the tight area that you would want to act on as a swing trader, when RMV15 would just kind of generally show it's tight. It's not an RMV tight signal right at 0. It's just generally tight. So if you're a swing trader, I'd probably suggest RMV5 for the most amount of use cases. Here's an example comparing the two. We've got PLTR, the IPO base. Another reason to use RMV5 is that it needs less price action to train it. So here we've got a longer base. RMV doesn't start showing until here. It still, of course, shows that tight area right here before we broke out. But RMV5 identified other tight areas, within the base as well. So you can see this is more sensitive and needs less price action to train RMV on that particular stock. Here's an example after large expansions, RMV15, because this is such a big expansion, that expansion is being considered for the next 15 days. So everything kind of appears tight, even though it is tight here, everything kind of generally looks tight. While RMV5, you only need 5 days of look back. So it's a little bit more sensitive to tight areas after a earnings gap. Here's an example of weekly charts. I like using a look back period of 3 or 5 on weekly charts. This is Nvidia before the nice breakout earlier this year. Another great example of how RMV on a weekly can help you spot, if you're a position trader, the bigger moves. RMV went to 0 right here. It formed this tight area right before the breakout, and RMV with a look back of 3 can help you find that. So here's another example. This is RKLB back earlier in its run. How RMV5 can help you spot the tight areas. Here's a tight inside day. So here's an example of a prime setup within an overall tight area. You've got this tight area right here. And what we do the next day, we expand higher, we go tight again, RMV5 goes to 0, expand higher a little bit, go tight, RMV drops quite low again. You get an upside reversal. So again, a prime setup. We expand higher again, form this base here. We get another tight day here. RMV5 goes to 0. We're primed. We get an outside day, expansion higher, and this has continued to, play that same tune, show, repetitive action over and over again with these tight areas, expansion, contraction, expansion, contraction. And here I am highlighting that for you. I didn't realize I did that, but again, here's another tight area right before an expansion higher, RMV tight signal right there for you. Here's a shorting example. So again, expansion can happen to the downside as well. So here we have an overall base. We've got a key level that forms the low of this base, and we get a tight inside day. So again, a primed short setup in this case, and we get expansion to the downside. I think this was like 30% in 3 days. And if you're a short artist, you can definitely use RMV as well to play those expansions to the downside. This is key. And let me get a sip of water before I explain this here. Not all RMV tight signals are created equal. I want to stress this. Somebody who hasn't really taken this webinar and looks at this just might say, there's a lot of false signals. This RMV is useless. But the important thing, as I've stressed many, many times, is that the context and the overall setup matters, and the overall stock matters. And you only really want to be looking at RMV at proper instances, such as, as a base is already mature and you're looking for that last entry point. And that's where RMV shines, is identifying a nice tight area in an already mature setup. Within a base, there'll be tight areas that form, but not all of those are actionable. So again, the top half are just over the base breakout. That's when you want to be looking for tight areas. The first 21 EMA pullback, the high momentum, first pullback to the 10 EMA, low volume on the pullback, shakeout, upside reversals, larger themes and catalysts. All these add up to make a tight area much more significant and much more potentially actionable as an entry point in a strong stock. So I want to make this very, very clear. So let's get into trading tight areas now. 3 steps for trade execution with VCPs. First is discovering the stock. You can't trade a stock If it's not on your radar, it's not on your watch list. So you can use Deepvue presets and RMV to do that really, really quickly. And I'll show you guys exactly how to do that. Then from that point, you want to build a focus list of the tightest setups, the most mature bases, near a key level, such as a base pivot or prior all-time high. Or you can incorporate other criteria such as fundamentals, the theme, the growth, the end factor. And then, as we'll go through, you can execute using one of four entry tactics. And for all of these, you want to use alerts and let your software do the work for you. You want to be looking for high volume run rate as it breaks through a pivot. And then as it kind of matures and continues to break out, look for explosive price and volume moves. And we'll get into many different examples. Excuse me. And here in Deepvue, our alerts are kind of tuned to look for just this stuff. We let you know in your alert that it's breaking above its price action on the day, the price it currently is at, the relative volume. So if relative volume is 2 times normal, we'll show you right here. And then price surge. This is something that I haven't seen anywhere else. Price surge is the percent change over the last 15 minutes. So if the price surge is 0.5%, 1%, the stock is really moving up on, with a lot of momentum going into your alert. So this is very useful information. It helps you know if an alert is really actionable at that point. All right, so trading a range. There's 4 different options. So we've talked about tight areas. Here, you've already identified a tight area. Now, how do you trade it? Well, the first thing you can do is accumulate versus lows. And Rye, who works at Traderline and Deepvue, this is kind of his forte. He notices a range and then he starts accumulating and setting very, very tight stops versus the lows of that range or just below that. And you enter as it pulls into it, moves back up, pulls in, moves back up. You might have multiple times where this happens and then it breaks out. That's one way to trade a range, but you might be stopped out a little bit more. But the advantage of this is that you can keep your stop really, really tight and accumulate a pretty big position before the stock actually resolves that tight area. Then the next option, and by the way, you can kind of combine these different 4 options depending on your style. You could start a position versus lows, then buy anticipation, then buy the full breakout, and kind of tier your buys and build into a position that way while managing risk. But the key with this is there's 4 different ways to buy and set your stops when trading a range. The second way, we've already covered the first, is to buy tightness / anticipation. Within the range, you can enter setting a stop at an intraday high or low, or if there's an inside day here, this could be the low of the inside day, which could be a little bit higher than the low of the range. You can enter there looking for the breakout, anticipating the breakout. Maybe it's already moving up on the day towards this level, and that's your anticipation. But this is another way to enter while managing your risk very, very tightly when trading a range. The next way is an undercut and rally. This is maybe when we're trading a range and then we get a gap down in the morning and the stock gaps down below the range lows. Everybody who's been accumulating has been stopped out. They have to buy it back. We get a rally back through the low. That's your entry, setting your stop at the low of the day or the low at this turning point. This could be your first entry. Then you can combine this, of course, with entering in anticipation of the breakout of the range, the high of the range, or at a relevant high or low on an intraday chart. But this is kind of the undercut and rally entry point here, entry tactic when trading a range. Then the last way is a range breakout. This is the classic. You've got a tight area, you're breaking through the pivot point, you enter, setting your stop at the higher low or the low of the range, and that way you can manage your risk. And then you can even add on another higher low that forms. But we can, again, these are the 4 ways: accumulating versus lows, buying tightness / anticipation, undercut and rally, and then the range breakout. And you can combine these, whatever suits your style. Depending on the situation, it might be different too. We might not get an undercut and rally if we don't get a gap down in the market, or there's not some type of news event like a secondary or a news catalyst that initially the market interprets negatively, and then we rally back through. So this might not happen, and you might be forced to wait for the range breakout. But this one is solid. It works in the best environments, but it doesn't give you the best risk reward because you can see your stop is a little bit, further than this one, which uses this low, this turning point, or these especially, which is versus the lows. So there's kind of a benefit to each of these, but also cons because you might get shaken out a little bit more of this. So it kind of depends on what suits your style. Do you like buying weakness? Do you like buying strength? It all depends on what you personally like to do and find success with as a trader. But those are the 4 ways to trade ranges. All right, handling fail tight areas. This is really, really important because again, not all of these work. They work in the best markets, the best setups, and they might fail initially and then set back up and then rocket higher. So it's all about keeping your risk managed so that you can give it another shot if you want to. So this is an example with coin. I tried this, got stopped out on this day. It looked like it was working really nicely. This was lower in the base, so lower quality, but it looked like it was working. Then it turns around, reverses down, stops me out. But what happens, over the course of the next week or so, this is why you keep it on your radar. It forms a settled tight area, stocks being accumulated here. It moves higher, pulls back again, then goes tight again. RMV goes to zero and sets up another tight area that then goes ahead and works. So this is why you want to keep a failed tight area on your radar because maybe the stock or the market just wasn't ready yet to go. So if it forms another setup, you want to go ahead and execute it. If the overall setup is still valid, the overall context is still good, the theme is still strong, all of that comes into play. And this coin, of course, rocketed higher and had a really nice, tremendous move. This time it worked, this time it didn't. And often a failed tight area breakout actually almost improves the setup because a lot of people may have tried this, it fails, they get discouraged, and then it sets back up again, they don't take it, or maybe they buy it late which adds fuel to the fire because they're annoyed they missed it. Whatever may be, the second setup after a failed breakout might even work that much better than the initial opportunity. It more matures the base and gets things a little bit more primed as well. Here's another example with Peloton. This is one I traded as well, got stopped out the very next day, and then Peloton dropped 80%. So that's why protecting yourself on these failed breakouts is that so important. But again, RMV going to zero. I didn't even have RMV when I traded this, but if I did, you could have screened for RMV equals zero, and this setup would have shown up right there on your screen. We get a nice breakout, looks good, close the day at highs, but then what happens is a later stage base reverses down, breaks the moving averages, and drops 85%. Again, you want to protect yourself. You don't want to ride a downtrend. You want to just give it another shot at the next opportunity, which never really sets up for Peloton to the long side until actually recently, which is kind of interesting. But again, great example of protecting your risk. And I think I got stopped out at break even or a very low loss because I moved my stop up slightly as it worked here for you. But definitely a really good example as this dropped again 80-90% from this point. Duolingo, this is a recent failed example. This one, of course, worked, but then it sets up a nice base. This one tries it. I got stopped out again on this one, but it sets back up here against the 21 EMA. Even becomes a better setup because you have the shakeout here, undercuts the 21 EMA, holds it, shows accumulation, gets tight again, and then this sets up a really nice potential entry point within this base. That's a little bit more mature at this point than back in this area. So that's another really good example of a failed tight area. All right, screens for tight areas. Within Deepvue, we have presets that look for low RMV stocks and help you find these tight areas. We also actually have a slope indicator now, a slope data point that allows you to use the 3 EMA slope to again find a really nice tight flat area, which might be a little bit more prime. But we have these presets created there for you that you can just access in the drop downs, and it'll right then and there can find you pretty good opportunities. I personally use these and look at them, but primarily what I do is I use our general Deepvue leaders preset, which is also available to all users, and that finds great growth names, setting up all different types of setups. And within that, I sort by RMV from lowest to highest. So zeros at the top, then it goes to 1, 2, all the way to 10. And I spacebar through and look at all those charts and see if there's a tight area that forms. That's a different way to do it, but this could be a more specific, faster approach if you have limited time. It all depends on your style, what you like to do with your screening. But these are the presets that you can go ahead and use. And what's even greater is with Deepvue, we've got a mini chart view, which you can access by clicking this bar. And then you can go through these screens really fast, looking at the overall chart in context and see if there's any that are actually worth actionable. And you can click these checkboxes and then add it to a watch list. So this mini chart view, which allows you to just kind of scroll through 6 charts at once, really speeds up the screening process and helps you find those best ideas that much faster. You can go through, I've gone through 300 charts in like 10 minutes using this, and it saves a lot of time during your routines. And as I mentioned, this is kind of what I do. I load the Deepvue leader screen, and then I click the top of this header twice to sort from lowest to highest in terms of RMV 15 days. That's this data point here. Let me actually go ahead and zoom in. So this is RMV 15-day basis. You can screen by this data point. You can add it to your data columns here. You can add it to your data panel in here, so you can always know what the RMV is. But the important thing is I screen by it, I sort by it, and then I spacebar through all these names, starting at 0, going up to about 20, and look for tight areas that then I mark up pivots, set alerts, all of that, and that really helps me speed up my routine quite a bit. So let's go ahead and show you how to do this live and show you exactly what I do. But first, as I mentioned, I do want to emphasize that we're doing a Deepvue Black Friday special offer right now. Here are two feedbacks, testimonials from existing users. For existing monthly and annual subscribers, you want to go ahead and email hello@deepvue.com to get our best offer ever on the annual deal. And you can lock in as many years as you want at $390 a year. And if you're a new, if you're not a user currently, definitely take advantage of this and go to deepvue.com, and you can check out right there. Basically, just go ahead to deepvue.com, click the button, and you can sign up right then and there. But existing users, please go ahead to hello@deepvue.com, email us and mention Black Friday deal, and we'll go ahead and send you the details and walk through everything step by step. I also want to mention that we're doing the Traderline Black Friday deal as well. We've got a sale on all our master classes. We just did one with Leif Serede, which was excellent, on high tight flags. We basically showed RKLB live, and it ended up being a fantastic example that went up 70-80% from the entry point we showed in class. And he goes through step by step his entire process. And this class really transcends high tight flags. It basically is a swing trading masterclass, a mini swing trading masterclass. That's really, really excellent. So highly recommend checking out the Leif Serede masterclass, as well as all of these. I mean, we've worked with Oliver Kell, obviously the record holder for the U.S. Investing Championship, Stan Weinstein, market legend, the author of that book right over there. And I'm extremely proud of all these masterclasses that we've put together. Each one is well worth taking, and probably many of you watching this have taken these classes, and please, in the chat, if you've taken one of these classes and think it would benefit another trader, go ahead and mention it in the class which one you took, and kind of what your favorite key takeaway was, and why it's valuable for somebody else to take advantage of the Black Friday sale. And I'm sure they can speak to their favorite parts of all those different classes. But go ahead and visit traderline.com/university. And you can go ahead and check out all these excellent deals. All right. And I also want to mention that in the context of the Black Friday sale for Traderline, we're actually running a flash sale on the Oliver Kell Swing Trading Masterclass just this weekend. So if you're interested in this, I think this is the best one. If you've never taken a class from us before, start with Oliver Kell's Swing Trading Masterclass. And just this weekend, you can save an extra $100 using this code, extra 100 STM. Enter that at checkout. Highly recommend that. I learned so much from Oliver. He's a fantastic teacher. And over the course of 5 webinars, and they're 5 webinars that are about 3-4 hours long each, going really into the details, the nuances that matter. He teaches his whole system from finding leaders to trading them, his entry setups that he likes to use, how he sells. This is just a fantastic resource. I'm so grateful to have taken this and helped produce it. And I think it can really benefit traders out there, whatever your skill level is, especially if you're a beginner. If you're a beginner and this is your foundation, you will accelerate your learning curve dramatically. So go ahead over to traderline.com/university, use this extra discount code to get an extra $100 off. Really, really worth it. This is a steal for this price. The ROI on this is fantastic. One trade can easily pay for this entire class. Let's see here if there's any feedback here. From Jose, high tight flag masterclass with Leif is excellent. I've also taken Stan Weinstein, John Book's class as well. All great courses in my mind. Thank you, Jose. Appreciate that. And you get lifetime access to this. I see a question from FD. Is the Oliver Kell webinar class for life for only 1 year? You get lifetime access to all those different webinars. Jay said, I took Leif and John's classes. Great way to speed up your learning curve. Awesome to hear. Martin says, I took the Leif Serede recent class and can highly recommend it. That's awesome. So thanks so much, everybody. Sopro said, I took many classes and they are good. Thank you guys so much. Yeah, so definitely go ahead and check out traderline.com /university, and we'll probably send some emails, some follow-up emails, letting you guys know where you can find these as well. But with that said, let's go ahead and dive into the live demo here. So let's go ahead and load that up. And I've got a few stocks to go through, just some different recent leaders. And let me know in the chat if there's any key stocks that you want me to go over. And Purvis says, guys, highly recommend Stan Weinstein's stage analysis class, life-changing, great to hear. John says Oliver Kells, John Boyk, and Leif courses are great. So thank you guys so much. So listen to your fellow traders, check out the holiday sale. I think it's an excellent deal on all the master classes. Each one is unique and complements each of the other ones. And you get to hear so many top hedge fund managers, US investing champions styles, and get to learn directly from them. Extremely valuable. So go ahead and check that out. All right. So we've got some stocks here. Perfect. Okay. So let's go ahead and dive right in. And I wanted to kind of show RKLB live with you guys to show one, how RMV 15 versus 5 works, but also why you might want to benefit from RMV 5 here. So this is a faster mover. If we bring up the data panel here, let's hide this. You can see the ADR on a 10-day basis is 11%. So this is definitely a fast mover. But let's go ahead and change this to 15. That's how you change it. By the way, you click the gear icon, then you can adjust that. You can see that there's so many expansions that anything that's not an expansion in this type of stock looks tight. So it's not as actionable, or it's not pointing out as significantly the subtle tight areas. It still is pointing them out because you can see this inside day, very tight RMV. But in this case, when ADR is so big and everything that's not an expansion looks like a contraction, I would definitely go over to the gear icon, switch this over to 5, and then you get faster signals where you can see, this is still high. This is highlighted as expansion, that, this is tight. But, it's a lot more precise in terms of trading these stocks to use an RMV5, and you get this inside day expansion, goes tight again. So I highly recommend RMV5 for anything with the ADR over 4 or 5%. It just is a much better signal, even though you get kind of more expansion signals. So ASTS would be another example of that. You can see tight area here, RMV going to 0. And again, this will show up on your screen if you're just screening for RMV tight on this day right here. And then you can play the breakout expansion. And again, this subtle tight area inside day, RMV going to 0, and then the breakout the next day, allowing you to profit from this nice expansion. Let's go ahead over to Tesla as well. I want to highlight one more thing. So Oliver Kell, his year in 2020 was excellent, and he's a fantastic trader. And that's why he capitalized on the amazing opportunity that was Tesla that year. But his initial entry point was very subtle, and most traders wouldn't pick up on it. It was this inside day here. He noticed this higher low forming, the push up higher, then subtle tight area right here. This is where he built most of his position. And what happened on that day? RMV5 went to 0. If you didn't have RMV here, this day, if you're advanced, stands out. It's tight right under this pivot. But if you don't have RMV and you're more of a beginner, or just getting started and still training your chart eye, you might not notice this potential entry point or the expansion the next day, and can completely miss this or have to wait until later on in the move. But if you have RMV, this is pointed out. It will show up on your screens. It'll be at the top of your watch list if you sort by RMV. So that's kind of one of the key benefits, and a precise example of how RMV can help you spot those big winning stocks before the nice expansion moves up the right-hand side of the base. So that's a good example. It also showed up, of course, right here. And there are actually many tight areas with RMV that provided great entry points. So just want to use that as an example. PLTR, this is an example of an expansion move higher, 10 EMA pullback. RMV going to 0 2 days ago. You get the expansion Friday. We'll see if that falls through to the upside. Is a little bit short-term extended. But back here, you can see again RMV going to 0 at the 21 EMA test. This is after the expansion move higher. This would have been a great entry point, or play the gap and go the next day. Again, RMV tight area right here, expansion move up. So there's another good example of that as well. Let's go to Axon. Recent earnings gapper. RMV5 helps you identify this. So there's another great example of a post gap tight area that now is expanded higher. We'll see if this falls through. There's a little bit of a later gap. I prefer ones, the first gap or second gap in a move. So let's go ahead over to this because this is actually from the Trade Lab, my recent newsletter from the 20th, some names that I was looking at, and I'll kind of show you why I was looking at them. It was all because of RMV. So ACLX loves to expand higher from tight RMVs. You can see a tight area here, expands up. Let me click shift here. Expands up about 18-20%. Another tight area here, highlighted right there. Expansion up about 25%. So that's why this was on my radar. Expanded nicely Friday. Upside reversal, tight area that forms right here. That's why this is kind of on my radar for a swing trade name. Acts as well, post gap. Was tight a few times, but was tight right against this base level. Again, this is always the best possible scenario, is when the tight area forms on low volume against a otherwise significant level to base pivot. And then what we get expansion higher. Axon was on my list. Deck, tight area right here. So again, I was screening for these. This is why, my routine takes about 30 minutes each day. It's because I can use RMV to speed it up and find these tight areas. And then we've got the expansion move Thursday and Friday. This was on my newsletter because of RMV here on this day right here. So you're ready to profit from this type of expansion move. LC as well. This was on my radar because of the tight area. I was sorting by it and noticed this. And then I know LC is part of the fintech space, the finance sector, which has been rocking and roaring. And you get a really nice move through these highs in a short amount of time, about 10%. Great for swing traders right there. Shop is formed a tight area, a little bit of expansion up, tight again. So this is still a little bit immature post gap, but you had a potential entry point through these highs, and then this inside day is another potential entry point, and we'll see if this sets up again. I'd love to see it go tight again one more day. RMV would definitely drop down to 0 if that was the case, but this is a good example of a post gap and how RMV acts just like that. And if you have RMV 15 on after a gap, you can see how the signal isn't quite as actionable. It still is pointing at the tight action, but it's less sensitive, so it's less significant when it goes down to 0 or 5. So I personally usually keep it on 5, but 15 is great for most traders. So that's, I think, pretty much what I want to show here. So let's go ahead and show the screens. So first, the thing that I do when I do my routines, I'll clear sorting by clicking that icon right here, is I go over to screener presets, Deepvue leaders, and then this looks for basically the top stocks in the market. These are the top names in terms of momentum, growth, fundamentals, all of that comes into play. If you only use one screen, this can be it. It usually shows 100 to 200, 250 of the top names in the market. All the names that are leaders will show up on the screen during their moves. And what I like to do is clear sorting. I like to sort by RMV right here. You can see if you click the header once, it goes ahead and sorts highest to lowest. DDOG, another great example of RMV tight right here, expansion higher. This expanded, so that's why RMV is 100. Gap as well had an earnings gap, that's why expansion is 100. NNE also expanding higher. RH also expanding higher. RMV tight area right here before it moved higher. But if you click it again, then you're looking lowest to highest. And if you just spacebar through, you can see tight area on the right-hand side. But overall, the context isn't great. You've got this level to play against, but it's a little bit whippy and not too precise. But I just kind of spacebar through, look at the tight areas and see, is the overall context still actionable? And Geo, which is showing up, this is relatively tight, but the better tight area is where it showed up right here, as you can see, and before this expansion bar. So that's where it showed up on that. And I pointed out in the newsletter as well in real time. So I'm looking for tight areas, but they've got to be in a good overall setup. We've got a pullback here, not the best pullback. You've got a gap down, but pretty tight right here. So that's why it's been pointed out. MTZ, PRCT, if this pulled back one more day, upside reversal, this tight area would be nice and primed. RDNT, recent gap, pulled back down sharply, now forming another tight area. So this could be actionable here through those highs. SITM. So, this weekend, a lot of stuff has already moved. So some of these tight areas aren't very primed. UPSD has shown up a few times here. It was primed Thursday. I had it on my radar here. Inside day, so still potentially actionable through these highs. But I'm always looking for, an overall strong chart. And lift is a nice, decent pullback. We'll see if it pushes higher. But I'm looking for the overall context again. So that's how I spacebar through and complete my routine and look for those top stocks and top ideas that are showing those tight areas. Shop showing up right here. So it helps you spot the VCPs as well as the recent earnings gappers. It's sorting by RMV this way. The other way, as I mentioned, is you can just go to Screener Presets and type in Volatility Contraction Pattern, and then these will show up. These are names that are still tight and have shown a lot of power, and you can use the other screen as well. If we go back to this one, the tight range screen, that's also another good one to sort by. So let's go ahead and go through a few names that you guys suggested here. And do I sell at RMV 100? No, not necessarily. It just means that it's expanded. If I've got a nice cushion, it's probably one I want to ride for a few days at least. If I'm swing trading, or if I'm position trading, it's probably just starting a nice move. PG says you could just sell this indicator all by itself. Yeah, but it's a great add to Deepvue, so that's why we incorporated it into the platform here. Dave, yeah, good example. So Dave, it was tight here, and this is one where it got tight again, but RMV got a little bit higher, and that's because it was so tight in this area that this is relatively looks a little bit looser. But when you see a name that gets this tight, you want to get it on your watch list and then keep watching it for a potential scenario. Dave, I know nothing about the software or anything, but this is showing power up the right-hand side here, potentially starting a U-turn here, actionable. Friday was on the newsletter. So yeah, definitely one to watch, but really nice power. I know nothing about the software, but that is another theme that's currently pretty darn good. Let's see here. Yeah, deck, another good example. Yeah, this is one that I pointed out previously. This was on my newsletter, pointed out before this expansion. CVNA, yep, that's one that's been coiled in this area. Nice upside reversal. This would have been a nice early signal, and then still got tight here on a relative basis, but in terms of RMV5, didn't get tight. Let's see, 15. So it was RMV tight based on a 15-day. RMV5 was almost a little bit too sensitive here, but it was very tight on a 15-day basis. And back in this area, all these were highlighted by RMV. Pod, yep, tight. This is why it's been on my radar after an expansion move up. I love a stock that shows power and then forms a tight area. That's kind of what I'm looking for. Oklo, this is one that's a very fast mover. So again, you want to switch this to 5. And it showed RMV tight signal right this day, right before it took off, 20%. Yeah, 20%, and then nice tight day as well. I love to see a short-term flag before it attempts these highs here, and that would set up another RMV tight signal right there. All right. Let's see if there's any cool questions that I should answer here. We've covered a lot today. It's been an hour 47, so a little bit longer than I expected. But definitely really good stuff that we covered. Let's see here. Martin asked, should the tight area be flat or is upward sloping okay? That's an excellent question. This is why we've added the, let me go ahead and save screens. This is why we've added the slope. Let me zoom in here. The slope data point is, actually, maybe I don't have it in. Oh, I think I'm looking at the wrong thing here. Anyway, we added the slope data point to help prevent this, because ideally the tight area is either flat or slightly decreasing, and we get an upside reversal right at the end. Because if it's rising, it's not really tight. It's kind of wedging upward a little bit, and it's not quite as explosive a mover. It can work, but what I prefer is a tight flat area or a slightly sloping down one. And you can use the slope moving average data point. Let's say we want to add that here. You can go ahead and type in slope, and you can either do it in percent or ADR per day. And we just updated the search functionality, by the way. It's so much better. And you can basically put in a range in terms of ADR of minus 0.2 to positive 0.1. So basically pretty flat, but maybe sloping a little bit down. And then it'll restrict all the results that show up to basically a flat tight area. So that's a great question, Martin. Let's see here. Nicholas asks, if I already bought the Black Friday offer, can I purchase another year? Definitely. Shoot us an email at hello@deepvue.com and we'll sort everything out. A lot of people have locked in 4 to 6 years using this deal. It's the lowest offer we'll ever have again. So definitely take advantage of that if you'd like to. Let's see here. Preston, shoot us an email about the founders for Trade Lab if you'd like. Rick asks, if I take the Deepvue trial, can I still get the Black Friday deal? Yes. Just shoot us a message and we can set that up for you whenever you'd like to upgrade to the Black Friday deal. Alex asks, will it be possible to personalize the multi-chart? Yeah, we'll have updates for that. Let's see here. For monthly charts, I like to use 3 or 5, just like weekly, in terms of the RMV level here. So if we go to app again, let's X out here, discard app, change to a that zoom toolbar 1 month. If we change this to 3, there we go. So I like to use 3 or 5 for a monthly and a weekly. So Bob, yeah, I would suggest 3 or 5 for a monthly or weekly look back period. All right. And there's a question, can you use it for ETF? Certainly, if the ETF is setting up, it will show a volatility contraction pattern and you can use RMV to help identify that tight area. No problem at all. All right. All right, I think we've covered a lot today. So again, thank you guys so much for tuning in. Let me know your feedback in the chat. Hopefully this was very helpful to you guys and you enjoyed it. There's still hundreds and hundreds of you. So thank you for spending a little bit of your Saturday with me. I highly recommend, as I mentioned, checking out the Traderline Black Friday deal, as well as if you're interested in the Deepvue Black Friday deal, you can go to deepvue.com or send us an email at hello@deepvue.com and mention Black Friday, and we'll provide you with all the details and let you know exactly what to do. Deepvue is, a passion project of mine, and all the founders, we work extremely hard on it. Every single day, we're brainstorming new ideas. We're incorporating feedback from you guys, and it's the best platform for swing or position trading because of the features that we've implemented that are unique, such as bubble charts, dashboard, customizable heat maps, data panels, RMV, other indicators like RMV. I'd highly recommend checking it out if you haven't already, and take advantage of the Black Friday deal. I think it's an amazing opportunity. This will be the lowest price we ever offer. So again, visit deepvue.com or just shoot us an email at hello@deepvue.com and mention Black Friday for details. So thank you guys all for an amazing session. Also want to highlight again, we're doing a flash sale on the Swing Trading Masterclass. To get an extra $100 off, go to extra or type in extra 100 STM at checkout, and you can go ahead and activate that deal. But thank you guys so much for tuning in. I really hope that this was valuable to you guys and helped you develop your chart eye and learn to master the VCP setup just that much better. So thank you guys all for sticking with us. There's a lot of thank yous in the chat, which is great. Yeah, thank you guys so much. And I'll see you guys in future videos on Twitter, and happy trading. Cheers.